Happy Thursday, everyone. Our presentation is on cryptocurrency and international transactions. Today you have myself, Peyton O'Malley, as well as Jackson Grant and Jacob Bristol. We will be talking to you about number one, what is cryptocurrency, its effects on international trade, arbitrage opportunities in our research analysis, as well as our conclusions. First off, what is cryptocurrency? It is a digital form of payment which can be used globally to purchase goods and services and also utilizes blockchain technology, which we will talk about next.
Yeah, so in the backbone of cryptocurrency, it's blockchain that makes it secure and safe. So let's say I'm a small business and I am transacting with another small business in Africa. If I send them cryptocurrency, it's going to register within a block. And each concurrent transaction is going to also register. So each block builds on one another. And every block is in reference to the other using a specific algorithm, and all of these blocks form a chain, which is called a ledger. Now, the brilliance of cryptocurrencies is not the ledger itself, but it's the fact that that ledger is in a distributed ledger system. So these computers within the ecosystem are sometimes referenced to as miners, and they essentially solve algorithms which verify that the payments are correct and use private and public, cryptographic keys to solve and validate the chain. So if I try to tamper with one of the blocks within the link, I'm going to essentially cause a change in the outcome of the equation, and it's not going to match with any of the other computer's equations. So it's going to be counted as fraud and not be added to the ultimate link, which is how it's theft-proof.
Cryptocurrency effects on international trade boils down into four main points. In theory, cryptocurrency could disrupt the foreign exchange market, but only if one cryptocurrency was adopted throughout the world. Currently, Bitcoin has 30% market share and growing. Banking has transfer charges, transfer limits, technical issues, and more data breaches. Crypto is faster than banking, has negligible transaction fees, instantaneous transactions, and blockchain technology as cybersecurity.
And in general, here are some recent stories that we've seen with cryptocurrency and how it's affecting the international world. First off, Citibank predicts that Bitcoin could be a currency for global trade within the future. Like Peyton said, it's already had a 30% adoption rate, and they say it's at the tipping point where it's either going to become the majority currency or it's going to fall through. And on top of that, with cross-border transactions, in Nigeria, the naira is actually very in a liquid currency, and the banks give transaction limits. Like Ezeki, he only has a $10,000 transaction limit, and he can't buy goods from China because he has to convert it from naira to US dollars and US dollars to yuan. And the banks there, they charge massive fees, and it's very difficult to do. So he uses Bitcoin, a cryptocurrency, to circumvent that problem, and his transactions are instantaneous. And last but not least, cryptocurrencies have essentially run a fine line between investments and actual currency asset class, which is why governments, especially like Italy, are starting to regulate them because they're very volatile and there's no really central authority holding them down.
So speaking of regulation, because cryptocurrency is not backed by a central bank or it's not regulated by a central bank, the price can fluctuate pretty wildly. The price of like a fiat currency like the dollar, the central bank can hold the fiat currency at a specified level. But with a cryptocurrency, there's no central bank. No one is holding that at a specific level. In that instance, it kind of acts like a stock, like Jackson was speaking of earlier. It kind of works like an investment, and because of that, the price can fluctuate wildly just due to just supply and demand. If there's a lot of demand in a market for cryptocurrency and not a lot of supply in that market, the price will go up. The price will appreciate for that cryptocurrency. On the other hand, if the supply is high but the demand is low, the price will go down. The price will depreciate. So that's basically just how the cryptocurrency market works. Another interesting thing to realize about the cryptocurrency market is in many of the markets and many of the exchanges, you have to be the in the country where the market is located to be able to trade on that market. So what happens with that is what that means is if I'm in the United States, many times I can't trade on Corbit, which is the Korean market. Or if I'm in the United States market, I can't trade on the European market, or vice versa. And what that creates is that in some markets, some of the users might have reason to increase their demand. There might be an increase in demand in one of the markets and not an increase in demand in the other markets. So what that creates is a price discrepancy or mispricing of the Bitcoin or of the cryptocurrency in the markets. And what that leads to is an arbitrage opportunity. So that leads us to what we did for our research. What we did is from March 8th, 2020 to March 8th, 2021, we downloaded data for the European exchange for cryptocurrency, the United States exchange for cryptocurrency, the Korean exchange for the cryptocurrency, the euro and US dollar spot rate, and the Korean and US dollar, the Korean won and US dollar spot rate. And what we did is we downloaded the data. So I'll talk about the euro first. What we did is we downloaded the data for the euro, the spot rate for the euro. We had the open and close for a year of the euro. So we had 2 price points for the year, 2 price points a day for the year. We also downloaded the European Bitcoin exchange and what the prices were at the open and close of every day for a year for the European market. And we did the same for the American market. So if everything was perfect and there was no arbitrage opportunities, if you look at the top left graph, this graph would be a straight line at 1. And what this graph means is if we divide the implied spot rate, so if this price of Bitcoin in the United States divided by the price of Bitcoin in European euros, it should equal the spot rate of the US dollar to the euro. And if that were the case, there would be a straight line every single day. But as you see, it's not a straight line. What this means is that at certain times, the implied spot rate is higher or lower than the actual spot rate. And what that creates is an arbitrage opportunity. If you look at the bottom 2 graphs, you see that's the magnitude of the arbitrage opportunity. So if you take into account longing and shorting, so you take advantage of discrepancies when the implied spot rate is too high and too low, and you are able to take advantage of both of those, then you're able to really realize the profits that you want to realize, and you can realize a pretty significant amount of profits. So we used $1 million to buy Bitcoins on the first day, on March 8th at the open. Then we would sell the Bitcoins for euros, or we would use the dollars. We would either convert them to euros and buy Bitcoins and then sell them in the American market. We would take advantage of the mispricing, and then we would reinvest those profits, and we would basically we would buy in the undervalued Bitcoin markets and sell in the overvalued Bitcoin markets relative to the spot rates. And if we go to the next slide, we can see what the profits were like. So you see that we see at the end of a year, $140,000 of risk-free profits. That's 14% risk-free profits, just from reinvesting 2 times a day. Now, we could have seen even greater profits. We could have reinvested every single time, every single second that there was a misprice, but we didn't. We only reinvested 2 times a day. And what this goes to show is that with the lack of no central authority, the prices in the foreign Bitcoin markets, they're not consistent. And due to the varying levels of supply and demand, they're not consistent with what a fiat currency or what the spot rates are going to be. And until someone regulates this and makes it to where the Bitcoin market has to stay the one certain price across all the markets, this arbitrage opportunity will be there. Now, it sounds really easy and it sounds good, but we need to realize as well that spot rates and foreign exchange markets are very illiquid. They are not liquid. It's hard to realize profits it's hard to just quickly change between different exchange rates and different fiat currencies. So that is something that would slow down this arbitrage. It would make it harder for this arbitrage. Also, you have to be in the market. So a retail trader might not be able to trade on the Korean market or on the European market if they're in the United States. So that's what makes it hard for retail traders to find this. Another interesting point is Bitcoin for less developed countries can be seen as kind of a safer investment because it's just safer. They might feel it's safer than their banks, and it's safer than their fiat currency. So they might be more prone to have more volatile Bitcoin markets, which could make their arbitrage opportunities greater and just greater in magnitude and amplitude, just because their price, their demand and supply might wildly fluctuate. So if we go to the next slide, we see we did the same thing with the Korean won, and you see that again we only traded at market open and market close, and we just saw that the arbitrage is possible by longing or shorting. And what we see here is that it happens in both markets. It happened in the Korean won, it happened in the euro. And if you go to the next page, you can see the profits that were realized. And in this profit, there was 9%. In this market, there was 9% risk-free profit, which is pretty great for a year. And interesting, just summary of this, arbitrage with cryptocurrency, it's tough for retail investors, as I said before. It's hard to predict the discrepancies. And another just quick note is that intermarket arbitrage, so between different countries, is much more lucrative than intramarket arbitrage between different exchanges in the same, different people that sell Bitcoin in the same US exchange. It's not as lucrative as between different markets and regions.
In conclusion, cryptocurrency is a digital payment that is secure, instantaneous, with little to no fees. Because there is nothing backing it up, like in fiat currencies, the prices of crypto can vary widely across markets depending on demand and supply. One region can experience a price increase while another can experience a price decrease, which causes the arbitrage opportunity. No central bank is hedging to make sure the price doesn't run crazy, and this is the consequence of deregulation in banking. This will remain until any regulatory agency jumps in to regulate crypto, which seems unlikely to happen in the near future. Thank you so much for watching our video presentation. Here are our sources. And if you have any questions, please put them in the chat or ask us in class after you watch our video. Thank you so much. Have a great day.